long-winded. I'm sorry. The problem is that most people expect returns to come within a year or two. That's how long of a leash they give people. We did a survey on Twitter where they said, how long would you tolerate a manager underperforming before you sold that allocation? And it was like 80 or 90% said under 6 years, and most said under 3. There's been survey after survey that shows institutions are just as bad, by the way, where they say they'll give 95% of managers under 3 years, and then they fire them. But the academic literature shows that's the exact opposite of what you should be doing. The 3-year time horizon, most institutions, they've shown this over 10,000 hiring and firing decisions, would be better off staying with the manager they fired and not adding the one that they're adding to or including now, because they just revert. And if you don't mind, give me a little latitude here. Let me give you a good real world example. I used to tell clients, they'd ask me, say, Meb, how long should I give this strategy? And you can extend this to asset class, anything you want. How long should I give it? And I used to say 10 years, and now I say 20. A good example is the stocks versus bonds currently. Everyone knows stocks outperform bonds. It's been 40 years, and they haven't. Will we expect that going forward? No. With bonds at almost 0% interest rates versus stocks, you would absolutely expect stocks to outperform. But that wasn't the case 40 years, so you got to wait. But let's use Warren Buffett. Everyone knows Buffett's an amazing investor. Everyone didn't know that in 99. Article after article saying he's lost his touch, he's old fuddy-duddy. And we wrote a book called Invest with a House that you actually used to talk to Mark a lot about this, where you could track hedge funds, what they're doing through the 13F filings. So you could buy what Buffett buys when it's public, top 10 holdings, equal weighted back to 2000 when the filings became electronic. And that outperforms the market by about 3 percentage points per year. That beats 95% of all mutual funds. You don't have to do anything. You could also buy Berkshire. The 13Fs outperform by a little bit, but it's very close. You don't have to do anything. It takes 5 minutes a year. You just hired the best performing portfolio managers on the planet, and Charlie Munger too, and now the new guys. But why would anyone never do that? It's because they go through ridiculously long periods of underperformance. Buffett has underperformed. We're ignoring what's happening this year. I have no idea. The last 17 years. So of the 20 years, he's underperformed, and it's like 11 out of 17 calendar years. So every institution, every retail investor would have given him a 3-year leash, and then you're fired, Warren. You're fired, Charlie. But I just gave you a prescription to beat 95% of all mutual funds, 0 cost, takes no effort. But no one would have been able to withstand Buffett because of that mismatch we're talking earlier. But this applies to active management too. So going in with all these asset valuations and the struggle with why this is so hard. If you look at the world right now, after it's been imploding the last few months, the good news, stock valuations in the US have come down from 32. I don't know what today is happening, but down to about 22. So we're back to normal valuations for low inflation. That's great news. It's not back to normal full period, which would be another 20% from here. And it's not back to global financial crisis lows, which would be, I hate to say it, another 40% from here-ish. And it's certainly not back to all the way to 5 where it's been before. But you also have to hold in your head the chance that it could go back to 45, right? Or all-time highs. If we cure this, we find out that chloroquine works or there's new vaccine, boom, we can go back to highs. You have to hold both possibilities in your head, and most investors can't. Foreign developed is probably down to, 15. Foreign emerging is probably straight up at 10. And the cheapest countries, we update this every month, every quarter on the idea farm and send it to investors. And happy to send it to y'all's list. A lot of countries around the world are going to be P ratios about 5 and about 7, which are generational buying opportunities. These things doesn't have to be this week, this month, this quarter, could be this year, could be next year, but things you could be allocating to where you will get probably 15, 20% returns going forward, but it's going to be really hard. It's good. You may buy them and they may go down 20% more. I got to pause there. I've been blabbering for like 20 minutes. So if you're still awake,
listen, it's incredible because what you're basically elaborating on and kind of hitting from multiple perspectives is this idea that if you are a short-term investor and you want immediate results, one, you're likely not to get them, and two, you're actually going to make really bad decisions, right? Because if you're looking for that kind of quick feedback loop of, hey, I bought X, it didn't return what I wanted in 12 months, let me go change my strategy. It's kind of this belief that the average is the average for a reason, right? And so if you go through 3, 4, 5 years of underperformance, well, the average performance is higher than that. At some point, it reverts back to that, right? And it's kind of the thing that Mark always says around, people kind of buy what they should have bought because it's at the all-time highs and they think that it's, all rosy, but then also they sell what they're about to need. So they sell it after, a couple of years of underperformance, and then all of a sudden it goes on, the run that they were all expecting 3, 4, 5 years before. And so it really comes down to, I think, one, the emotional discipline, but also two, the ability to understand the math behind a lot of the decisions, right? Which you've done a great job of articulating, and just kind of trust that the math works. And what I find when I talk to a lot of investors is it's almost like they know the right answers, but they feel like they have to do something to feel in control. Right? Because if I underperform 2, 3 years in a row, rather than stick with it, if I do something, then like now I'm in charge and I can kind of get myself out of this. And that usually is just a really bad strategy.
We had a quote that we put out in this piece this past week, again, channeling Bogle. We probably would have disagreed on so many things, but we think he's wonderful, where he had a great quote where he said, during crisis, most people want to do the, don't just sit there, do something. But the reality is you'd be better off with, don't just do something, stand there, sit there, do nothing. And so for most people, we said the whole point of this is you have to have a plan. As Peyton Manning, as football goes the line of scrimmage, he has the plan. And you come into this and say, look, this is my plan. Now your plan could be basic. It could be, look, I'm going to do global market portfolio, rebalance once a year. So rebalancing has the effect of you're guaranteed to be adding more to the stuff that's gone down and cheap and trimming the stuff that's gone up and expensive. So it's that constant discipline. There's a topic that we talked about in a podcast with Howard Marks and Robert Knott, where it's this concept of even you could go a step further and over rebalance or calibrate, meaning you add a little bit more. And maybe say if you had 60-40 portfolio, you go back to 60-40. Well, maybe if stock valuations are super cheap, you go 65-35. But notice it's never like 90-10. Most investors, they want a super binary, all in, all out. But in reality, it's better to just trim a little bit. And you get the blended outcome of all expectations. But yeah, as if you have the plan, and one of the beauties of a lot of approaches today is you can automate those suckers. We've said, we demonstrate for public assets, most people, you build your portfolio, you let it sit, let it whir in the background, and you just should never touch it again if it's automated. And so we have a digital offering that does this, and as well many others. And it makes the adjustments for you, so you don't have to worry about it. You almost see it as a savings account, and it just kind of keeps your hands out of the cookie jar. But if anything, in times like these, people start to act batshit crazy. There's some things and dislocations you could add a little bit, but this is all on the periphery, right? These are little tilts you want to be making, not wholesale. I got to be all in on stocks or all out, because all that matters is this sort of sleep at night portfolio. And I love to sleep. I really, really do. I have a young kid who's quarantined now, as well as we all are. So I'm probably not sleeping as much, but the portfolio is not bothering me, because you have all the stuff planned ahead of time. And it takes away a little bit of the interest in mucking with it.
Yeah, I know a lot of people like to talk about the